what I found is that the companies that perform the best over a 10-year period never were the top in any 1 year.
The immediate volatility after the Liberation Day announcements and NZX first day, it ended up the day up.
If I look at websites of fund managers, they often talk about a 1 year, a 3 year, maybe a 5 year record. If I'm investing for a longer term than that, then actually that's not really relevant for me.
Kia ora koutou, welcome to Shared Lunch. I'm Garth Bray. Congratulations if you've made it through the past few weeks with your nerves holding. Investors haven't seen this volatility for more than a decade. How are you coping? And how are you looking for the positives and opportunities? Well, we're in Wellington today, and helping me look for those things, we have some sparkling talent in the form of Paul MacBeth, editor of The Bottom Line, and Susannah Batley, company director and also head of Sharesies Business arm. Before we get started, here's some important information you should always consider when investing.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Welcome to both of you. Paul, you took the boldest bet I can think of in the first quarter of 2025 and launched a business. So congratulations on the bottom line. Susannah, you're a director at Deliver Easy, as well as helping out with the business side of business here at Sharesies. So, I mean, a lot on your plate, obviously. Congratulations and welcome to 2025. What are you doing for stress at the moment? How's your stress levels?
I find it pretty calm. I mean, we're at the bottom of the world with a 100,000-mile moat surrounding us. It's quite easy to be in New Zealand and watch on while Rome burns. I mean, it's the last couple of weeks and this year in general have certainly thrown up a lot of things to think about. But it's the same thing, New Zealand has that relativity thing, right? Things are bad here at times, but when you look overseas, you're definitely shaking your head.
How about you? Are you waking up every morning checking the numbers and checking again?
I mean, I am still checking the numbers, but what I've actually found really helpful for me is actually looking back in history and continuing to look at other times where there have been a lot of volatility. The reasons have been different, but I do think that if you don't engage with history, then everything feels unprecedented. So I've found that to be quite a calming thing to think about and look at each time that's happened, that life does go on and markets do continue.
So you're looking at the cycle and trying to work out where we are there and work out what happens next, or at least take some stock from the fact that this is not unprecedented.
That's right. I mean, I don't try and analyse the future. In fact, even that is a really odd phrase because the future hasn't happened, so there really is nothing to analyse. And I have really no idea what's going to happen. And if I look back in history is really a series of surprises. And so it's very hard to then think about what that next surprise is going to be. But I do think it is good to focus on some of the things that we do know are likely and sort of thinking about what a good response to that might be. It is hard to continue to invest when you're seeing your portfolio go down in value and knowing that that might persist for some time and things might look worse even the next week. In fact, Howard Marks, who is someone that I really enjoy his books, and he's got a very famous memo that I think he's written since about 1990. And I came across Oaktree Capital during the GFC, where at about the last sort of 4 months of the GFC, Oaktree Capital were deploying about $600 million US into the market every week. And that was as the market was continuing to deteriorate. And so every week, what they had purchased the week before was worth less. And then they kept doing that again and again and again. And that having that high conviction and be willing to put up with quite an extended period of volatility is really hard psychologically. And that's why often in the past few have been able to do that. But for the people that can do that well, it's been incredibly fruitful over the long term.
I guess, I mean, if you can compare it to house prices, obviously there'd been pandemonium if they dropped like 15% since February, like we've sort of seen with the S&P. But admittedly, there will be people out there licking their lips and going, great, finally, this is my chance to get into that market or double down or so on. And it's the same effectively with equities, right?
That's right. I mean, house prices, I think, is an interesting one, and I think gets overlooked a bit around the impact of leverage that has as well. So, when people might buy a house, if they have funding it with 80% of a mortgage, then that leverage really amplifies the outcome. And that's great when things are going up, but that can get pretty catastrophic when things are going down. And so when we've seen house prices move down, that return on equity gets a lot more negative. It's amplified because of the effect of leverage, whereas in the equity markets, a lot of people investing are not using leverage to that degree. So it's interesting, that house price analogy.
Not since the 80s anyway, yeah.
Yeah, that's right.
Well, I want to get to debt a little bit later on, because obviously it's a big part of what's behind what's been going on coming out of the States, I suppose. But the reason I asked about sort of stress was this is probably a little bit like kind of a health check time for a lot of people with their portfolios, would you say, Paul? Like, it's like, am I comfortable with this amount of risk?
Definitely. And they should have been doing that already anyway. If you're looking at equities, you know you're going in with something that's volatile. There are a lot of other products out there to mitigate that. I mean, the handy little risk profiles that we get in various disclosure statements, the 1 to 7 being you're going to have to tolerate some downs with the ups, and think about it over a long period of time. I mean, I still struggle when I see these statements looking at a long-term investment being 5 years. That's not a long-term investment. You're day trading if you're thinking that's your sort of profile. If we think about Kiwi Saver, 40 years. This is a generational product, so you can go through these sorts of things. And looking at, the immediate volatility after the Liberation Day announcements, and NZX first day, it ended up the day up. We were the first market to open. We eked out, in the final 15 minutes of the match, where all of the big money's sort of trying to set their final prices for the day, ends up in the green, having been sort of, in the red for a lot of it. Then you get the Wall Street reaction the following day, slaps everyone. We finally get it on the Monday, where it comes down a bit domestically. But you'd look at those numbers, and I remember I was looking back at, say, sort of height of GFC, height of COVID. Height of COVID was, I mean, some of those movements were nonsensical. You couldn't quite wrap your head around it, even thinking about the likes of West Texas intermediate oil prices going negative for a stage, like mad. But GFC, going back to, it was a smaller, slightly bigger than the dot-com bubble in the early 2000s. But over the course of it, you're sort of going, okay, we're feeling this now because it's happening right now, but we felt like this in the past. And that's how you try and sort of think back into your mind. Okay, if you're thinking about equities, it's a long-term thing. It's so easy to get caught up in the ups and downs. You do want to have an idea of going into things. What am I comfortable with? And revisit that every now and then. Like, let's have a look at it, maybe quarterly, maybe yearly. What do I think about my portfolio now? What do I need sort of over the next 6, 12, 24, 30 months type thing, and adjust accordingly or not?
It's like a health check, isn't it? You kind of check in maybe once a year with your doctor if you can get in to see them, and go, how are things looking? It's a chance to say, is my strategy for the long term working right now, and do I need to adjust it? Would that be right?
Yeah, and I do think sometimes living through these moments are the reality check to actually go back and look and go, am I diversified enough? Do I have enough cash on hand? Are those settings right for me at this stage of life and for my risk appetite? I think when it comes to investing, it's really important to understand whether we are trying to maximize for the short term or optimize for the long term. And those are two very different things, and they're actually at odds with each other. So if you're optimizing for the long term, most of the time, I would say by definition, that means not maximizing for the short term. And it means actually not maximizing for returns when times are good. And again, psychologically, that's quite hard. For the last couple of years, I'm very well in NVIDIA. And every time that I go and look at that stock, I go, I think it's overpriced. And I would invest. And then sure enough, I was wrong and the price will keep going up. And I do think there are times when things are going up where people could maximize short-term returns by taking on more debt, having lower cash levels, going more into individual equities and maybe having less diversification. But what that also does is it does make your portfolio more or less resilient to large volatility and large periods of uncertainty, and less resilient over the long term. And for people that really are looking to optimize over the long term, and if we look at the formula of long-term wealth is your sort of return to the power of time, that keyword is time, like it's to the power of time. And so if you're thinking about endurance and thinking about maximizing for the long term, then sometimes that does mean holding back a bit in terms of trying to maximize over short periods of time, because actually you really want to make sure that you can survive the 1 in 20 year event or the 1 in 40 year event. And that's quite different.
The what if moment that we're all kind of going through now.
That's right. And I think when what we do know so far is that over long periods of time, there's been lots of periods of volatility, but that markets overall have done well. And so that does go back to going, am I diversified enough? What does diversification look like? And is my time horizon, to Paul's point, long enough? And I agree with 5 years is just not long enough in my view to be really thinking about the equity markets.
You're looking more like 10 or longer.
Yeah, or longer. I mean, I think Warren Buffett made something like, 99% of his returns after he turned 60, I think. And that's just because of that exponential, that power of time, that it's all been in the latter years.
But he made some pretty smart decisions before that, I'm sure.
He did.
Yeah. Coming back to the NZX, and you were talking about how we actually managed to perform a little bit out of step with those market moves. There's obviously a lag there. I mean, has it been a good guide for the volatility that's out there, the performance of that market? And are we sort of seeing it reflected, or are there some local things that we need to think about there as well?
We'd definitely follow those trends. Like you're looking at it, and you don't tend to see the same peaks and troughs that you get on that daily basis over sort of the short period of time. That's where you saw 5% going on the NASDAQ. You might get a 3 on the 50.
Might that make it a bit more of a defensive play?
It definitely is.
Yeah.
When you're looking at the top 10, top 20, you're looking at utilities. You got the 3 government-controlled power companies, an airline which is government-controlled, a broadband provider that got into businesses that it probably shouldn't have. Fisher & Paykel Healthcare is probably the most interesting one out of there, and has been an astonishing success. There are always a lot of what-if moments. And it does often make you wonder whether or not we've got the risk settings right. It's one thing for the market to be defensive, but the trading volumes on the NZX 50 were pretty low throughout this entire period, even though activity sort of perked up throughout it all. When you're looking back at sort of the actual volume of shares trading, and you're looking at maybe 120, 130 mil in turnover value of trading going through it on a daily basis. The reweightings of major indices a couple of weeks prior had massive volumes over that. You're looking at sort of equivalent volumes going through the Brexit back in 2016, around mid-year, like that. That seems out of step when you've got some of the biggest trading volumes going on Wall Street over in Australia. And yes, people are sort of sitting and waiting to see what goes on, but you're just wondering, why is New Zealand not actually engaging in this? Is this just a function of the fact that a lot of our ownership is being done through passive ETFs now, and these are the vehicles that people are flocking to? It's really been quite curious as to wonder, have we got our risk settings right for what should be something that is there to support not only deeper capital markets for new businesses to be coming out there, but for investors to get involved in. You struggle to see the imagination getting captured by the New Zealand public at a time when more of the New Zealand public is sort of finally getting over the finance company debacle, the 87 crash. You're left sort of scratching your head going, what gives?
The data would suggest, though, that we are getting over those things. I mean, Susannah,
I agree,
that if you look at even at the Sharesies index that Sharesies produces quarterly, people are diving into those markets. Not necessarily the NZX, to Paul's point, but they're getting amongst it, aren't they?
Yeah, I've been really heartened to see the response to this period of volatility, where the latest figures from the Sharesies index over the quarter, January to March, showed again continuing strong net buying through this period, and then also a shift away from sort of more individual companies and into more ETFs and diversified funds, as well as into defensive individual companies as well. And I do think that reflects the fact that we are probably in for a period of continued volatility, and diversification is a really sort of important thing to make your portfolio more resilient to sort of withstand that period. I also think actually even before this tariff war and these geopolitical events that we're seeing play out. If I look at 2024, in the year, the S&P 500 was up, I think, about 25%, but about half of those companies had losses, so had a negative return for that period. And actually, it's a very few number of companies that accounted for the majority of that return. And I think that is a trend that we're seeing more and more, particularly as you have large tech players with high operating leverage, and you're seeing some more global companies. You are seeing the drive to the tails, and the tails that are driving for the big outcomes. And unless you can, really pick who those winners will be, and I certainly can't. Definitely would not leave my day job if I could do that. But unless you can do that well, then it's going to be hard to even beat the market return if you haven't got decent exposure to those very few, sort of fewer and fewer stocks that are driving the big outcomes. And so I do think that moving more to that diversified approach is really helpful as we're seeing that trend even beyond the volatility we're seeing off the back of the Trump saga.
That's just also one of those issues that you get around the shifting around the ETFs and the such. It's hard to look at, say, like the QQQ, the NASDAQ ETF, or the S&P 500 and really consider either of those to be diversified given the concentration of Magnificent Seven. And just thinking about people on Sharesies platform, this is Kiwi investors being drawn more to US stocks. And they're going down this, you get told to diversify your portfolio. Yes, American market should be one that you should go into. But if you're only going into 7 companies that are making up the dominance of it, it's hard to wrap your head around how you're actually diversifying your investment there. Or if you're just trying to ride the wave that we've all been doing for, the last 7, 8, 9 years now.
To Paul's point, though, when you look at, for example, an S&P 500 ETF, it is dominated by a very few number of stocks. And I remember a time on the NZX 50 where I think it was Fish and Paykel Healthcare and A2 Milk collectively were something like 30% of the index. And so unless you had, for fund managers that didn't have a massive exposure to those two, they almost always underperformed the index at that time. What we are also seeing, because we call a lot of our Kiwi Saver members, and we are talking to our investors all the time. And another thing we're seeing is we're actually by and large seeing investors not disengage. So they're not going, I'm just going to put my head in the sand and try and just forget about this period. We are seeing investors actually continue to check in with their balances, but also they're saying, actually, this is just part and parcel of being an investor. And I think that really is a shift in mentality of what we've seen in previous periods, particularly amongst retail. When I'm talking to investors, I've seen a really big shift in psychology where it is much more volatility is the price of investing. And it's not a penalty, it's not for doing something wrong, it's literally the price of being in the market. And actually, when I do talk to investors, the things that they're worried about is not volatility in the short term, and they shouldn't be. Like for investors taking a long enough time horizon and are diversified, volatility in and itself shouldn't be the issue. The issue is, can I lose some or all of my money, or am I going to get inadequate returns for the risk I'm taking on? Those are the issues that investors need to be concerned with. Not that short-term volatility.
Yeah, I guess Kiwi Saver is probably a huge part of that equation, right? People are now directly invested. They can sort of see a little bit about their piece of the world. And that's probably leading a lot of financial literacy as well. I guess the fact that it's locked in, right? Yeah. That people are in there till 65 or whatever, or until they buy their first house, if that's where they're trying to push it to. So that's got to be a big part of this, yeah?
Totally. And dollar cost averaging in, like that is the Kiwi Saver strategy. Like every month money gets deployed, whether or not people are feeling good about it and looking at the balance. And obviously, only investing at the top of the market is not a good strategy. So dollar cost averaging does rely on investing when markets go down and continuing to deploy money during those moments, which, as we've talked about psychologically, is challenging.
We do have some slightly unusual Kiwi Saver settings here where we sort of tax it going in, whereas a lot of other countries will just say, you make the money, you grow your pie, we'll have it when you cash it out, when you're retired. Things like, is it time for us to look at that and say we need a health check on?
We should be looking at that all the time. The esteemed commentator Brian Fallow, who very smart columnist at the Herald for many, many, many years, would regularly point out about the horrendous change that was made when Roger Douglas was finance minister to change that setting around the tax. You're clipping the ticket on the way through, and what government wants to give up that money, which the ultimate taxpayer doesn't see? Like you're not aware of how much you're actually paying. And until we had the sort of, it might have been the COVID crash, when you're looking at the annual Kiwi Saver balances, it was almost about that time where the tax take was going to be bigger than the fees generated. Now, it's kind of immoral for the government to be a bigger beneficiary of the privatising of future savings than the people that it constantly complains about. It's a horrendous setting.
I kind of imagined it's a little bit like trying to steal food out of the mouth of the animal that you're trying to feed, rather than just saying, hey, one day we're going to, it's going to meet its end and we're all going to eat. It feels like they're trying to take too much too soon. But like you say, it's locked in and probably hard to reverse. But are there other changes we'll be trying to make?
Well, I mean, everyone's pushing for increasing contribution rates,
Yeah.
which makes sense. I mean, even if you go back to Dr. Cullen when he was setting it up, the staggered rate of 1, 2, 3, 4 going up 1 percentage point a year to minimum, and then wanting to be able to get for it to go up to 8.
I mean, the great thing with Kiwi Saver is it really does maximise for that time horizon. And I think as humans, for most people, and I say this for myself, compounding is not intuitive. Like if someone said to me, what's 7 plus 7 plus 7 plus 7, I'd give them the answer. If they said, what's 7 times 7 times 7 times 7, I'd just say, that's a really big number. I personally think the compounding formula will be the most useful formula that my kids ever learn. And I just think that it's very hard to visualize and really understand how powerful that is over decades.
Look, we've managed to get through this mostly without a lot of talk about Trump or tariffs or any of those things. It's been in the background there, right? Because every other day it's a new thing, right? But coming back to what we were talking about with some of those New Zealand companies, those local companies, is there any way we can work out what those likely impacts are to be on some of the market players that we've got here?
Not yet.
Yeah.
I mean, well, because your first round had Fisher & Paykel Healthcare, which has significant manufacturing operations in Mexico, which were immediately slapped with tariffs before the big, Donald Trump versus the world, which was then paired back to Donald Trump versus China.
Super Slam. We should start giving it some wrestling metaphors or something like SummerSlam.
But
Here we go.
I mean, he is a WWE fan.
Yeah.
But it's their immediate thing was it's not going to hit our 2025 financial year because their financial year ends in March. So that gives them a bit of an out to then think about, well, we need to work out what the impact is going to be, whether or not we're going to be able to pass this on to our customers, whether or not we're going to shift more manufacturing back to New Zealand. They went through this in 2016. After the original, when NAFTA got torn up and Trump renegotiated the free trade agreement with Canada and Mexico, Fisher & Paykel Healthcare were looking at their manufacturing footprint and thought this is too much of a risk. We need to find another country to build things. They ended up settling on a Chinese factory, which came on stream. It might have been last year or the year before. Can't quite remember. But this is how every company is going to respond. They will look at what the rules are going to be, and they will work out what will we get hit by and how can we get around it, and how else should we respond? I mean, NVIDIA promising to build $500 billion worth of AI servers and their supercomputers in America. That's exactly the sort of behavioural shift that this White House administration wants to see, whether or not the tariff regime would have forced their hand or not. It's counterfactual, we've got no idea.
Whether they've got the consistency coming out of the White House that these businesses can actually use to make those decisions as well, right? Can we just get a deal instead?
Yeah, I'm intrigued to see actually how much manufacturing will move to the US, because there is quite a lag in terms of that response to then going, we're actually going to build a factory or we're going to set up a factory, and that takes time. And I'm seeing various sort of countdowns as to when Trump, when his term will finish, and look, who knows what will happen at that point. But if if that takes time and you think that will get reversed, then you do sort of work back and go, well, actually, is that worth it or not?
There are always going to be winners and losers throughout this entire sort of situation. Some people will find the opportunities and others will get burnt, which is kind of capitalism, right? I mean, it's not a win-win-win-win-win, no matter how much the sort of well-manufactured press release tries to pitch it as so.
Yeah, and then another interesting thing is thinking about what the long-term consequences might be of all of this as well. Even if things are completely reversed, that doesn't necessarily take away the fact that this has happened, and then what how will global fund managers look at the US, or what will be certain views around the US dollar moving forward, and that's really hard to predict. What that might be.
I was just thinking, Milford, our local fund manager in New Zealand, they had already been looking at the valuations in the US and gone, that's a bit toppy. And they had been paring back their US exposure and shifting it to Europe, where things were looking like a better value. And you saw in the first quarter up until Liberation Day, which liberated us of our gains, that some of those European defence stocks have been going through the absolute roof in Europe, primarily because they couldn't trust on being able to source American product anymore. But these things have massive budgets coming their way as well as a result of what could possibly be the dissolving of the NATO alliance, which is crazy when you say that out loud.
Yeah.
I did say we were going to try and be unashamedly local. I feel like we've ranged pretty far from home now, so I'm just going to bring it back. If we're talking about the NZX, there's something I need to ask you, Susannah. Strategic mediocrity. Explain.
Yeah, strategic mediocrity was actually a term that PIMCO, the global asset manager, used to use. I don't know if they still do. And it was really from a bond trader back in the day called Ben Trotsky. And in 2003, he retired with the best 10-year record at the time globally. And what Ben Trotsky had done is he analysed a lot of history, a lot of data, and actually found that if he could stay within the top third of performers each year, but not higher than that, so not on the top 20% or the top 25%, then actually if he did that consistently over a 10-year period, he would be at the top in any competitive universe. And really that what it is about is going, things change all the time, just as we're talking about. Things are so uncertain all the time. And so an environment that might produce stellar returns one year, if the environment changes, then that same strategy might not produce the same outcome. In fact, it's unlikely to. And so if the strategy is more about thinking about a really resilient and robust approach that will work in a variety of different environments, if you apply that consistently each year, then actually over a longer period of time, say a 10-year period, then that should produce really good outcomes. And I actually looked at this with NZX data, and it was really fascinating to see I looked at a range of different decades, and what I found is that the companies that performed the best over a 10-year period never were the top in any 1 year. And I think, again, it's that optimizing over the longer term versus maximizing over the shorter term. And I don't think we talk about this enough. If I look at websites of fund managers, they often talk about a 1 year, a 3 year, maybe a 5 year record. If I'm investing for a longer term than that, then actually that's not really relevant for me. I need to be looking at what that track record looks like over a much longer time frame. And it was interesting seeing some of the top performers on the NZX. I mean, Chorus was one that has produced some stellar returns over a 10-year period. And in fact, if you account for the sort of risk control as well, it's probably even better. So, I think it's interesting over the last few years, we've seen quite a big shift away from the NZX into the US markets. But I did look at a range of NZX companies, and actually if we take a much longer time horizon, there's been some really, really strong, consistent returns on some of these companies over a decade plus.
Paul, are there hidden treasures in there in the NZX?
There are always hidden treasures, but I mean, part of the problem around crystallizing value out of them is the lack of liquidity throughout the entire market. People won't touch anything outside of those top 20 companies. And when you're looking at sort of those mid and small cap companies, and these are why they're so often touted as takeover targets, because they're trading possibly even below the net tangible assets. That, if you were to liquidate them at a point in time, you would get more money than what you could do buying them all on market at that price. There are a lot of companies in that sort of space, and part of it is just because they've fallen out of favour. Part of it is that their owners, the shareholders, don't want to sell at the prices that someone else is out there trying to do so. But it's just really difficult to drive that activity to get a real, a transparent price, which is what a stock market, a forum for people to buy and sell is all about. Why didn't Rocket Lab get a secondary listing when it went to the NASDAQ? What are we doing in New Zealand that's not encouraging those companies that are managing to get from small to medium to big, or those hugely ambitious companies to think domestic, even if that's only just a component of it? Why are they completely eschewing us? And it's very easy to take a crack at the stock exchange operator and say, well, you're not sticking to your knitting, you're too busy off in funds management, wealth administration. Well, that's unfair. Like, they're just one component to the entire thing. Is it the 15 years of the conduct legislation that we've been operating under? Did that get it right? But maybe it's time to have a wee think about that. I mean, Sharesies has been a magnificent introduction into the market to at least inject, if not necessarily the value of trading that you see from the big houses, the volume of it. Like, retail investors are getting engaged through it and doing so, but more, it just seems to be like we've left something on the table. And if I knew what it was, I'd probably be sitting in, the top floor of PwC Tower on Commercial Bay.
Well, maybe the what-if moment out of all of this and the peaks and troughs of the S&P 500 is we need to look a little bit local and fix our own house as well and fix some of these things. Thank you so much for your insights, for your experience, for your calm. Really, stay calm, people, honestly. And as you say, just check in when you need to and back the long game. Thank you very much, Paul. Thank you very much, Susannah. Thank you very much as well for listening and for watching YouTube, Spotify, Apple, iHeart, straight off the Sharesies app if that's where you're getting it from. Thanks very much. Let us know what you thought. Let us know what you'd like to hear about. Kumatu, that's us for now.